This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We've had a look so far at equity settled plans where the staff are paid in share options. We said that there will be a charge in the profit and loss with a corresponding credit to equity. We've looked at cash settled situations where we said there would be a charge in the profit and loss with a corresponding credit to liability. Finally, there are a couple of unusual situations you may see when you're deciphering the words in a scenario, probably more likely to be in words than in numbers, but in case you recognize any of these words. The first one is extremely unusual, and it's where the employee or the beneficiary again is given a choice as to whether they should take the shares or cash. It's almost like saying to someone at a restaurant, do you want fries or do you want rice with your meal? So it's a very unusual situation. And all I want to say for now is that we know that if you are giving people shares, you credit equity. If you're giving them cash, you credit liability. If you're giving them choice, then basically you make a little bit of a credit to both equity and liability. If you remember from financial reporting, accounting for a convertible loan, when you see a convertible loan as a loan with an option to take shares instead. If you've forgotten your FR, by the way, that's in the lecture here, which deals with financial instruments. So you may not have studied or revised that yet, but you sort of met that in financial reporting. This is the same, and so if you do give people the choice, we use a form of split accounting. That means that you see it really as a cash settled scheme with an option to go for shares instead. So part of the credit is to liability and part to equity. So if that sounds like a foreign language to you, again, you might revisit that point when you've had a look at financial instruments again, because you'll then remember how convertible loans work, and this works in a very similar way. Now, a couple of bits of jargon that you might be expected to recognise. The first one is something known as a modification. Imagine that your staff are working very, very hard to achieve their targets, and they know that if they achieve their targets, that if the vesting conditions are met, they're going to receive the share options and all day be millionaires or something anyway. And then they notice that the share price of the company is kind of collapsing. They would lose motivation. So often you will change the scheme, and the reason that you change the scheme, modification just means change, doesn't it? Modifications, again, are sometimes used to give the staff an incentive. I think there's a verb to incentivize the staff. If you incentivize the staff, what you would often do is maybe lower the price at which the option can be exercised to give them a bit more benefit. Now, the International Accounting Standards Board gets very jealous about this, and it stands there with its hand on its hip and again waggling its finger and saying, if you're giving the staff more of a benefit, then you can make a bigger charge in the profit and loss account. So if you come across this word and it appears that the staff are going to get an extra benefit, then there will be an extra charge in the profit and loss account. They measure it by looking at the benefit that's obtained on the date of the change. As it says here in our notes, it'll happen if the fair value of what you're giving the staff increases, there would then be an extra charge in your accounts. The very last scenario is something that initially would not incentivize the staff if you cancel it. So if the staff have been working very hard for you for 5 years, stuffing sausages or whatever you've asked them to do, and then you say, I've decided to cancel the scheme, they're going to walk out, aren't they, and strike. So if you do decide to get rid of the scheme completely, you will have to settle. In other words, you'll have to give them some money. So if you do cancel the scheme, it's just a logical fact. You'll have to pay the staff. If you cancel the scheme and pay the staff today, then essentially the scheme is coming to a complete stop in about 1 second from now. So as it says, they will actually accelerate the whole cost of the plan. So if you had a 3-year vesting period and you were charging a third a year, if you suddenly cancel it in the second year, you'll charge both the second and third year's amount. Because presumably, you're giving the staff something of value at least equal to what they were going to get before. So as the notes say there, the cost of the plan will be accelerated, will speed up in the profit and loss. So earnings will reduce as a result. In some cases, there can be an additional profit and loss charge. So I wouldn't worry terribly about getting hooked up into numbers at this. But, if the staff are significantly better off in terms of the cash settlement, then, it may be that you have an extra charge going through the P&L at that date. If they were getting something with a fair value of 50 and you're giving them 60, there may well be an extra 10 to account for in the profit and loss. What we're saying then is that if in some way, looking back at this jargon we've been looking at, if you look at the 2 green words, if you modify or cancel the scheme, there may well be additional charges in the profit and loss which would reduce reported earnings. And that's as far as I'd want to take this with you at the moment.